What would your advice be?
Well, look at the large Chinese names on the NYSE: Baidu, JD, Ctrip, Alibaba. They're dependent on the Chinese consumer. So I think the Chinese consumer is just fine. If you really wanted to impact China, you got to go somewhere else.
But Gordan, what about all the companies that have expanded into China? I'm talking about big U.S. multinationals seeing a huge opportunity over there, spending tons of money. Even a company like Starbucks, it's not exactly trade, but it's a service. You know, what happens to companies like that?
I think those companies are certainly going to get hurt. And we already saw this with the fine that's going to be imposed on General Motors of almost $29 million. This is an indication, and this is the shot across the bow. But you got to also remember that these companies put themselves into an authoritarian state that is known for retaliating. And so although the U.S. should protect them, nonetheless, there are other economic interests that need to be protected as well. And clearly, because we have this $334.1 billion trade deficit with China last year, you know, China doesn't really have too many things that it can do to retaliate at the end of the day, because we can buy our shoes and our clothes and toys elsewhere. China cannot replace our market.
Yeah, Gordan, I was going to say it's, you know, kind of shooting themselves in the foot. If there is some kind of trade war, which would mean what, I guess? It would mean escalating tariffs. It would mean potentially voluntary decisions not to export products from one country to another. Would that hurt China more, or would that hurt the U.S. more?
Well, it would hurt China more because China has built up this manufacturing platform, and not just for U.S. companies, but for companies around the world. So China is in global supply chains. But if China decides to retaliate against the United States and American companies, it's not only going to go to war against American companies, it's going to jeopardize its position for all of these manufacturers. And so China has a lot to lose if it actually goes that route. And you've got to remember, China's exporters are already in trouble because of an artificially high renminbi, and for other reasons. You know, exports now are down about 6.5% this year. This is not a good story for Beijing.
Richard, what about the U.S. consumer? So especially at the retail level, where so much of this manufacturing has gone to cheaper China, I would imagine any kind of trade war means that retailers will pass along these higher costs. And we could be talking about 10, 20, 25% higher prices, right?
That's right. So the consumer at Walmart, where most of the products there are made in China, that's a concern. If I were Walmart or any major retailer, I would be concerned about that. The Fed is prepared for more rate increases. So if the shopper isn't doing it, and Donald Trump has to focus more on infrastructure and other forms of spending to keep that GDP somewhere realistic in the broader sense, because the world does still see the U.S. as the main economic engine, they're going to be in a conundrum. Do they continue to raise rates, or do they keep things where they are because the shopper is just not going to Walmart, or just tuning it down a little bit?
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.